Hello and welcome, everyone. Thank you so much for being here with us today. This is our webinar, Making Your Dollars Work for the Environmental Movement. We're going to learn about planned giving. But just before we start, I want to make sure that you know all the Zoom tools that are at your disposal today. So you have been muted, and that's just so that we can make sure that we can hear our speakers and everyone clearly. But please use the chat to say hello, introduce yourself, share where you're joining from, and go ahead and add anything that you're hoping to learn today from the webinar as well. We do have the Q&A feature enabled today as well. So if you want to ask any questions there, you can do so there, or you can just add them in the chat. And last but not least, we do have the ability to have captions today. So if you would benefit from the live captions, you can put those on just by clicking that CC button on the bottom of your Zoom window. And if you need any help throughout the day today, you can email us at info@wellingtonwaterwatchers.ca and we'll get you some support. Before we start, I just want to ground us with a land acknowledgement. We do something called a living land acknowledgement at Water Watchers, where we get to kind of ground into what has our journey been like with our learning and our unlearning as well, surrounding Indigenous sovereignty and the land that we're on and the waters that have fed us. So I personally grew up on the lands and waters that have been stewarded for thousands of years by the Payom-Kawitcham and the Luisweño people in San Diego, California. And today I'm joining you from my home in Cambridge, Ontario. And it's right in the heart of a piece of land called the Haldimand Tract, which was promised by the government of Canada to the Anishinaabe, Haudenosaunee, and Attawandaron peoples, who called this land home for time immemorial. And today we're gathered from many different lands that each have their own story and heritage, and most of these lands are stolen lands, unceded traditional territories from which Indigenous peoples and nations have been displaced and dispossessed in the name of greed and capitalism and colonialism, and all fueled by an undercurrent of white supremacy. I invite you to take a quiet moment right now, just for acknowledgement of and gratitude for the lands and waters that have sustained you, as well as some grounding reflection for the ways each of us can orient ourselves towards lives of action that support human dignity and honor the planet we call our collective home and connect us more deeply to each other. So I'll just give us a minute for that. All right, thanks for taking those couple breaths with me. All right, without further ado, let's jump into our webinar today. So we are joined today by our financial advisors, Candice Joy and Vlad Solokhine, to explore the world of planned giving, as well as some other avenues that can make your finances work better for the environmental movement. They will present on modern day philanthropy and efficient gift strategies, demonstrating the modern day techniques allowing you to enhance your philanthropic gifts, save on taxes, which is an important highlight, and get involved with your favorite environmental charities on a new level. We hope we're one of them. If you're here with us today, I think we are, but glad to be along on this journey with you. We also will be joined a little later by Kim, who is the VP of Development at Small Change Fund, and she's going to go through specifically how you can give through their Small Change Fund platform to their charitable projects underneath their umbrella there. We'll then move into a Q&A period where you can ask any questions that you might have, but please feel free. You don't have to save your questions until the Q&A time. Add them into the chat. I'll collect them all and we'll get them asked to Candice and Vlad and Kim in real time, which will be beautiful. Last but not least, I'll share a couple other thoughts just at the very end for how you can, some other ways that you can think about making your dollars work for the environmental movement and to support climate justice and water justice. It is going to be a fascinating hour together, so let's get started. I'm gonna pass it over to Candice and Vlad, who are our financial experts that are speaking today. I've seen this presentation before, and it's so interesting and so engaging, and we're really lucky to have you. I'll let you introduce yourselves too, say anything that you want about yourselves, and thank you again so much for being here.
Thank you so much, Danny. Well, it is our pleasure to be here. And good morning, good afternoon if you're coming somewhere else. My name is Candice Joy. I am a wealth advisor at Connor Clark and Lunn, and I work with families on their philanthropic giving, preserving their wealth, growing their wealth. But philanthropic missions and values are a big part of our discussions. So I'm excited to be here today to talk to you a bit about some strategies that you can enact immediately to help with your own philanthropic mission. Over to you, Vlad.
Thank you, Candice. My name is Vlad Solokhine, and I'm a financial planner. It just happens so that I specialize in philanthropy and helping people with disabilities and helping people who lost their job, just because those areas, they really interest me. It's part of what I like, where my passion is. And with this, I have always been fascinated with the system that our government created for charitable giving financially. I don't think any other country in the world has such an elaborate system of financial help for those who want to contribute to their favorite charities. And I always, again, was amazed how little it is known. The government on its own, yes, they created the system, they never advertise it for some reason. And it looks like it's all on us to learn it. So I will be happy to share what I know about it. And Candice and I will be happy to just give our view on how you can really enhance your donation power without putting any extra dollars on your side.
Thank you. So over the next 30 minutes, Vlad and I will talk about philanthropy, but more importantly, giving while living, and also leaving a legacy with tax efficiency in mind. And as Danny mentioned, afterwards, Kim from Small Change Fund will talk more on the practical applications of receiving donations and support for the Water Watchers initiatives. So let's get started. We have our first slide up already, and we wanted to start with this dollar pie chart. And this pie chart shows the distribution of your tax dollars. In other words, how the Canadian government decides to allocate their spending. And whenever I ask people if they would like to distribute their tax dollars like this pie chart, the usual answer is no. Now, how does this connect to philanthropy? And it connects because you can reallocate your own tax dollars to philanthropy instead with the full support of the CRA and charitable giving rules. And so instead of doing it like how the CRA really designates it, you can do it to your own personal missions and values that you want to support. So a quick example, and we're going to expand on this later, is instead of paying capital gains tax on selling an investment, a stock with high gains, you can donate that stock to the charity and not need to pay the gains at all. And this is all above ground. This is all completely endorsed by the government. We will expand on this with an actual example later in the presentation. And to summarize the slide, if you're thinking about how you want to distribute your philanthropic dollars, it is rarely like how this dollar pie chart is laid out. And this should be a wake-up call that if you're not strategic or purposeful with your estate planning and charitable intentions, your overall estate taxes will actually contribute to what we call in this pie chart involuntary philanthropy. So you're giving to this type of allocation without really your permission, which is the default distribution of your taxes and the state according to the government allocations. So on the next slide, I wanted to share where private foundations are allocating their charitable dollars. Again, this is not likely where you want to fund in your causes. And as you can see, only 6% of the private foundation money goes nationwide to the environmental sector. And if one of your philanthropic values is supporting the environment, you will need to take action to find and contribute to the causes and nonprofits like Water Watchers. On the next slide, I wanted to outline overall what are the 4 levels of giving to create impact. And since all of you are here today, you're trying to create that impact and to take action. The first level on the left is needs-based giving. And this helps with immediate needs like giving to a food bank, but especially in our current environment of high inflation really affecting food prices. You can see that food banks need the help, and you can see that people are giving there, especially in the last few years. The next level, one over to the right, is empowerment giving. This helps people enable other people to be more independent, like creating a community garden. The next level is capacity building giving, which is mission-based, and it helps move the organization's missions forward, like the good work at Water Watchers and what they're doing in fighting for water protection. And the last level on the right is systemic giving. And this is where your philanthropic dollars help with the research to get closer to a solution to collective problems like childhood nutrition, like saving the ocean, wildlife preservation, preserving the green belt. The list really goes on. So this is considered more of the systemic giving side. So when you are giving, you may not even realize what area and what kind of impact you are contributing to and how it's organized like this. But this is a very simple way to help keep things more mindful, to help your own mission to be more aware and organize yourselves and your values and contributions to society in a more mindful way. Let's move on to the next slide, and I will pass it over to Vlad now.
Thank you, Candice. Before we proceed with our presentation, I would like to stop and think, why are we here today? And I really like how Danny did it in the beginning of our presentation with land acknowledgement. You kind of pause for a second and you try to think, what is in it for you personally? How do you connect with this information? So yes, we all know and we want to know how to avoid taxes, how to avoid extra fees, learn some financial techniques, but really what brings us here? I cannot answer this question for you, but for me, it all comes down to generosity. Maybe it's a bit naive to think this way, but I consider generosity a superpower that I use towards those who are important in my life, my wife, children, and charity I believe in. And whether we want it or not, we create an explosion of generosity when we leave this world. Everything we build throughout life will go to someone, whether it's our family member, charity, or government agency. My point is, I want my legacy to be meaningful. It's not so much a question of how much taxes I will save, but rather how I will be remembered. And that is why today, trying to help you achieve your philanthropic goal, we will start with the challenges. We'll try to understand better what could stop us from making a sizable legacy impact, even if we have the financial resources to do so. So on the next slide, you will see 5 major concerns that may stand in the way between you and your philanthropic vision. Number 1, legacy giving could feel confusing. And to make things even worse, most people who try to explain it start with technical terms, such as capital gain, taxation, cash value, donation of securities in kind, etc., etc. Of course, if you're not a financial professional, those terms do not sound comforting and self-explanatory. It feels easier to ignore this complexity and just donate in cash. By the way, I just mentioned the donation of securities in kind. Candice and I will use this term throughout this presentation quite a few times. So to make sure everything is clear, I would like to explain that donating securities in kind simply means donating securities without selling them. All right, so let's imagine that you studied all those definitions, you're committed to making a difference and have some financial resources. And yet quite often we get the consideration or obstacle number 2. We might not want to give it all just to one charity. Many of us support 2 or 3 charities we care about and have relationships with. And if I have one portfolio of appreciated securities or a single life insurance policy, how do I split it between 2 or 3 entities? And that's not all. The third challenge is timing. As you know, legacy giving often provides substantial tax benefits. Candice and I will review some of them later in this presentation. And that is why our accountants actually often determine the opportunity to make a noticeable donation. And it might happen at an unpredictable moment, and the decision must be made quickly. You might not even have a chance to contact your charity to find out if they even can accept this gift that you are planning, such as life insurance or portfolio of securities. And that is how timing could be really an obstacle standing in the way of your legacy vision. Challenge number 4 is similar to challenge number 1, because legacy giving could be complex and unfamiliar for your financial advisor, your accountant, or your lawyer. And imagine you finally deal with all the confusion and decide whom exactly you want to donate and when. And then you call your financial professional and ask if it's a legitimate strategy. And if it's the first time they hear about this particular strategy, they might hesitate to recommend it. And that hesitation could be another reason why a sizable life insurance policy that you otherwise might not even need anymore will not help you implement your legacy vision. And finally, the dilemma number 5, how can I leave a sizable amount of money to my charity if I also have, say, 2 children and 6 grandchildren to take care of? I'm not going to spend much time on this now. It might be the most significant consideration of all, but later in this presentation, Candice and I will simultaneously address most of these challenges in just 3 minutes. And I promise you it will be a good resolution. But before we do that, let's spend some time resolving the first challenge, confusion. Let's quickly but efficiently familiarize ourselves with major legacy giving instruments. Let's move on to the next slide, and I pass it over to Candice.
Thank you, Vlad. Okay, so if we can go on to one more slide over. We are going to get started on talking a little bit about instruments of planned giving. And these are the main things that we will be covering today in terms of strategy. So donation in kind. So Vlad mentioned that term already. We will expand with an example of that. Donating life insurance. That's something that a lot of people don't realize they can do as well. The RIF and RSP beneficiaries, as simple as that gets, you can make very quick changes to your existing allocation of who the beneficiaries are and include charities in there to help out as well. And then number 4, charitable giving in wills. So we will talk a little bit about leaving a legacy that way. There's a really wonderful initiative right now in Canada called Willpower. I'll expand on that as well. And then lastly, donor advised funds and how to create a lasting legacy with your family in a very simple way as well. So these are 5 very simple but effective tools that we can use at any moment. We can use it immediately. We can also plan for legacy as well. So this is not something that you need to wait on. And this is really, really endorsed wonderful ways that the CRA encourages us to give. So let's take a look at the first one. On the next slide, we're going to talk about appreciated securities and donating them. So I wanted to reiterate again that the Canadian government has created one of the most favorable tax regimes to encourage charitable giving in the world. And in 2006, the Canadian government announced that some of the donation guidelines would change, which further incentivized Canadian taxpayers to donate by eliminating the capital gains on donation of appreciated securities that are publicly traded in your non-registered or corporate accounts. So this can't be from your registered accounts. It has to be from your non-registered accounts. So for example, if you bought some Apple stock in your taxable account a long time ago, you would be very happy with those gains, but also feel a little trapped because you have to pay tax on those gains. And what do most people do? They kind of hold on to it and don't really deal with it, and they just see the numbers grow. But what we can do is that if you donate appreciated securities of stock or bonds or mutual funds directly to the charity without selling it first, as Vlad mentioned, that's called donating in kind, There's a double benefit in that you will receive a tax credit based on your donation amount, and you do not need to pay the capital gains tax on it. If you donate from a corporate account, a medical professional, or a holding portfolio, you'll have a third benefit, which is that the amount of your capital gains donated will allow you to withdraw that same amount of capital gains tax-free from your capital dividend account. So in this example, we have a 30,000 appreciated stock donation. So say it's that Apple stock with original price of $10,000 of when you bought it. And you decided, well, I want to give some of that to charity, but say in the end you decide to gift all of it to a number of charities, but we'll keep it simple, pretend that this is one transaction. So you decide to gift to your favorite charity, Water Watchers. And so what you do is you get the same tax credit as a cash donation of $30,000, but you get the secondary benefit of not needing to pay capital gains tax on this stock. So that means that the $20,000 gain, you do not need to pay tax on it. And this makes your actual cost of giving of the $30,000 just under $13,000 versus if you sold the stock and to give straight cash, your cost of giving would be $18,000. So you want to be very careful. You don't want to sell it and then donate the cash. You want to give it directly. And a lot of charities have the ability to receive it. What it is just an extra form that you need to fill out and your financial institution can handle the rest. So it's a very, very simple way of doing it. So if you had the same example in your corporate account, you'd have the same benefits as I just mentioned under a different tax rate, but your capital gains of that $20,000, which is, again, $30,000 minus the $10,000 original purchase price, that will be a tax-free withdrawal from your capital dividend accounts to get $20,000 to take out tax-free from your capital dividend account. So this is an extremely effective way to donate to charities and to take advantage of the generous Canadian tax benefit. And I'm very surprised all the time, but there's lots of seasoned investors and donors who do not know about this. So this is as simple as it can get, that if you happen to have a non-registered portfolio and you want to take advantage of this, it's very, very easy to put in place, and you can do it immediately as well. Now, most places have a limit. So usually at $1,000 is the donation amount where they accept a cash in-kind donation, just because there's a bit of administration behind the scenes on all sides of the party. And that is the amount actually that the Small Change Fund does receive on the lower limit there. Okay. So we'll talk about this strategy later on in conjunction with other ones and how it can relate to creating a family legacy as well. So let's move on to the next slide and I'll pass it back to Vlad.
Thank you, Candice. I'm going to talk here about life insurance. And the beauty of life insurance policy is that it is very familiar yet powerful instrument that many people can use to enhance the impact of their legacy. Let's say that we have a 60-year-old woman who regularly donates $200 a month to a charity and every year gets an annual charitable receipt for a combined amount of $2,400. Assuming typical longevity, this woman will eventually donate between $60,000 and $70,000. However, if that woman buys a life insurance policy, the same $200 a month at 60 could buy her about $100,000 or more life insurance coverage, depending on type of the coverage and company that she uses, that she could donate to any registered charity. As you can see, she doesn't spend a penny more. She doesn't pay any extra setup fees or legal fees, and yet sizably increases her charitable gift. She could still elect to get the same annual donation receipt for $2,400, or select a single $100,000 charitable tax receipt for her estate, which might help the estate offset other tax liabilities, for example, on her cottage. And all this done with the same $200 a month, no change. This segment of legacy giving is so vibrant that recently one of the major insurance companies, Canada Life, introduced a particularly charitable life insurance policy. And it's designed in a very interesting way that it allows you as a donor enhance your donation, but at the same time, it allows charity to start receiving money immediately, not waiting for it for a few decades. I'm not going to get into details of that right now. I just want to make a point that donation of life insurance policy is in such high demand that even major insurance companies keep renovating their product as we speak. Another benefit of donating life insurance policy that it can be done in complete privacy. Somebody's will, if you think of it, is a public document, and every person related to the estate or not can examine and even contest it. A life insurance policy does not form the part of the estate. It does not have to be disclosed in a will or anywhere else. This donation could be legally made in complete privacy and nobody will know about it ever. However, since we're talking about privacy and donating to charities, keeping your charity informed about your philanthropic intention is a good practice. Board members and officers of all charities that I worked with kept telling me that they love to be involved with their donors. Of course, they're grateful to receive a legacy gift when somebody passes away. But if they didn't have a chance to establish a relationship with you, have you involved in their activities, or at the very least, keep you informed about the great things that they are accomplishing with your support, then something is missing. Relationship with the charity is a two-way street. They're happy to help you, their donor, as much as possible. And I know that they treat donors' confidentiality very seriously. So now let's move on to the next slide and review the strategies that you could use with your registered savings. Many of you know about the RRSP or RIF, so-called spousal rollover. When the first spouse dies, their RIF or RRSP balance rolls over tax-free to a surviving spouse. It would be best always to have your spouse as a primary beneficiary. But what happens when the last spouse or a single person dies? Could the money be rolled over tax-free to their children or grandchildren? Unfortunately, the answer is no. There are some exceptions for disabled dependents, but other than that, it's impossible. In this case, all remaining balances of their RRSP or RIF are considered to be their taxable income in a single year of death. And it's common for those accounts to have few $100,000 balances. And when it becomes an income in a single tax year, it triggers the highest tax rate, which is in Ontario, 53%. In other words, more than half of the money goes straight to the government and goes straight to that pie chart of involuntary philanthropy. That is why the main idea is that you do not try to pass your RRSP or RIF to your heirs. Instead, it makes perfect sense to start thinking about your charity. If you considered leaving some money from your estate to charity, the money from RRSP or RIF would be the most natural and tax-effective way of doing so. There are three options that you could use. Option number one, most simple but yet effective, making charity a contingent beneficiary. Both you and your spouse keep yourselves as primary RIF beneficiaries for each other. However, you add a charity as a secondary or contingent beneficiary. A contingent beneficiary receives the money only if the primary beneficiary is no longer here. And that is why by assigning charity on both RIFs as a contingent beneficiary, you and your spouse achieve two goals. A, if either of you passes away, the surviving spouse receives the balance tax-free, its spousal rollover, and B, the charity receives the remaining RIF balance when the last spouse dies. Unlike any other beneficiary, charity can issue a tax receipt that will offset the taxes otherwise payable on the RIF balance, that 53% that I was talking about. This is an excellent option for those who want the leftovers of their RIF donated to charity entirely. But what if you still wish to keep some balance to ensure your children and grandchildren receive the money? Then we move to the option number two. You buy a life insurance policy just on the side for the fraction of money that your estate would otherwise pay in RIF taxes. You make your children or grandchildren the beneficiaries on that life insurance policy, and at the same time, on your RIF, you designate a registered charity as a contingent beneficiary. And when the last spouse dies, children receive the life insurance payout tax-free, and the charity receives the remaining RIF balance and issues corresponding tax receipts so that the state will not pay any RIF taxes. This option requires understanding of the technical aspects of legacy giving and financial planning, so I would recommend seeking professional advice if you want to implement it. And option number 3, let's say that your children and grandchildren inherit the house, the cottage, and other assets. So you want the charity to get the whole RIF balance. And if you use option number 1 and assign charity as contingent beneficiary, it's good enough. But you still could increase that gift without adding any extra money, simply by using the power of life insurance in conjunction with the RIF. Do you remember my example when 60-year-old lady could donate between 60 and 70,000 of her lifetime in cash, but instead she purchased 100,000 life insurance policy? The idea combined with the RIF donation would be brought to a totally next efficiency level. You buy a life insurance policy and assign it to your favorite charity. You pay the premiums on this policy by using your RIF withdrawals. Under normal circumstances, your RIF withdrawals are taxable. However, registered charity will issue corresponding tax receipts to offset the taxes. So in other words, you take money from the RIF absolutely tax-free and pay for your charitable life insurance policy. And in many cases, the tax break would be even higher than the required tax payment. So you might even receive additional tax break, additional cash. It might sound a bit complicated, but believe me, the tax efficiency is incredible. I went through all these examples to illustrate that you have a choice. Either allow involuntary philanthropy by paying taxes or enhance your generosity without any extra cost. You might be surprised, but CRA will be happily to support you. They want us to take taxation in our own hands. Whether or not to take advantage of this opportunity is up to us. And now I would like to pass it over to Candice. Let's move to the next slide.
Thank you, Vlad. Those RIF and RSP withdrawal tricks are definitely a game changer. A lot of people don't realize it, and it's as simple as a government form that you can use to be able to withdraw tax-free from there. So now we're moving on to more of a legacy giving conversation. So you may have noticed a national campaign called Willpower that started 3 years ago. And this is a campaign led by the Canadian Association of Gift Planners Foundation. And it's a national public education effort designed to inspire more Canadians to make significant impact on the causes that they care about, with a gift in their will to charities that are near and dear to them. And in the beginning of the campaign, the stats were that 50% of Canadians do not have a will. And there's been so much conversation encouraging Canadians to create and to update and to leave a charitable gift in their will, let alone get a will to begin with. And Vlad and I are one of the founding partners of Willpower, and we're listed as professional advisors on the website. So feel free to use us as a resource for your personal situations, but also if you need a recommendation to a lawyer, to an accountant, to other people to help you with your situation, we have a really great network of people who do focus on philanthropy as well in their practices. So in the start of the campaign, only 5% of Canadians left a gift in their will. And with this active Willpower campaign for the last 3 years, the goal was to have 8.5 Canadians leave a gift in their will by 2030. So this sounds like a really long time and a really small 3.5% increase, but that small increase will generate $40 billion to charities. The great news is that we are 3 years in, and our research shows that we've moved from 5% to 8% already of Canadians who left a gift in their will. And that's 1.2 million more Canadians and an expected $37 billion already in future donations. So this is a huge shift in just 3 years of the campaign. And the goal of this was to be by 2030, we're well ahead of the game. So together, we really are all moving the dial forward. And a lot of it does start with education, but we can't stop here. It's not yet time to celebrate. The main thing to remember is that you don't need to choose family or charity. You can really structure it so that you can choose both. And even better, use some of these strategic charitable giving techniques that we talk about today to help your estate plan reduce down that tax burden for your loved ones and to redirect it to charity. This is the beauty of how the rules work within our Canadian system and with our philanthropic advice for the techniques here. So visit www.willpower.ca for more information. It is a very easy website to use and has a lot of free resources on there. And start your conversation today with your charity professional, like Danny, Kim, Vlad, and I as your trusted advisors, and make sure everyone works collaboratively with each other to make sure your estate is planned out purposefully. So let's move on to the next slide. We're going to talk about donor advised funds, or DAFs for short, at this time. And it's a financial term, a bit of the jargon, the confusion that Vlad talked about, used in our industry to describe your own charitable foundation. And the first question is, why do I even need one? So let's go through a donor advised fund journey illustration on the screen. On the left-hand side, you can see that you and your professional advisor, it can be your lawyer, your accountant, or financial professional, along with your charity professional, have been talking more about philanthropic giving, and you've determined that you have some excess funds to allocate towards charity. You also have some very large gains over the many years of good investing, and you want to think about how to strategically get rid of that and also not need to necessarily pay tax on this. So this leads to an exploration of setting up a personal or family charity. And there are many DAF administrators out there to choose from. That's for another conversation, but today we just want to focus on the concept of a donor advised fund, a DAF. And we want to focus more on how the DAF journey looks like and how it can help solve your existing tax burdens. So first, you need to fund your family donor advised fund through strategic donations, as we talked about. So you can fund it through Appreciate Securities, that Apple stock example that we talked about. So the charity on the other end of that donation can be your donor advised fund. You can fund it through life insurance, what Vlad was talking about. There's all those different ways. You can fund it through your RIF or RSP withdrawals using the proper government tax forms to contribute into your own DAF. And then that way you create a DAF structure and it's filled with like all of these tax-free goodness that you can then think about how to allocate and where you want to grant to in the different charities that you want to support. So that's talking about how you can fund the DAF. And as some people may ask, like, well, it sounds like it has to be a large amount. It can actually be as small as $10,000 to make it efficient. But some people like to just give $10,000 straight to the charity. But you can actually start this journey of making your overall family legacy in one place with as little as $10,000 in there. So on the other side, on the right-hand side, you want to begin exploring how you want to grant out the money according to your family values, your overall mission, your overall legacy vision. And these are conversations that takes time and effort and years really to put in place. But it will help you focus your personal or family philanthropy and integrate your overall vision and missions that you've identified. You can even support your friends and family walkathons or bikeathons through your DAF and no longer need to organize your tax receipts of the 10 charities you donate to because it is organized and centralized through your DAF administrator. I really like the bikeathons and walkathons idea because that every time it's a credit card donation here, because you've already funded the DAF with all of your charitable intentions, you can take it out from there to contribute to your friends and family that are asking. And since you're required by the CRA to grant out a minimum of 5% per year from your DAF, you have yearly opportunities to talk to your grandkids, your kids, about charitable passions. It becomes a great annual conversation at least. And then you'll be able to talk and make sure that everyone's happy in who we're granting to and how that works out. It's a great way to help educate the next generation. It's a great way to engage them as well. And always remember, when you are ready and comfortable, to let the charities know that you will be naming them as a beneficiary or you'll be granting money to them. They promise they won't bother you if you ask them not to, but they do want to give you appreciation and want to plan for their future. And it would be very helpful for them to know how they're going to be receiving the funds and the amounts and things like that. So let's move on to the next slide where I'll pass it to Vlad to summarize what we talked about today.
Great. Thank you, Candice. We talked a lot today about different legacy giving techniques, how they work, how they enhance your gifting power, what tax advantages you could realize by using them. And technically, it was all focused on addressing the first concern that we talked about, which is confusion. Hopefully by now you have a better idea of what instruments are available at your disposal, but other obstacles remain in place. How do I split my significant gift between different charities? What if I have to make a gift now, but I'm still unsure who should receive it and when? What if my financial professional doesn't know much about the gifting strategies that I have in mind? And finally, how about my family? I don't want them to feel abandoned or not appreciated enough. So I want to show you a complete philanthropic solution to those concerns. Let's move on to the next slide. And Candice already talked about this, so I'm just summarizing. The core of the complete philanthropic solution is the donor advice fund. As Candice explained, having a DAF is like having your charity in your pocket, which is ready to help you anytime you need it. You could combine all available legacy enhancers, donation of securities without selling them, life insurance, signing REIF beneficiaries, creating your will bequests, and direct them all into your own family DAF first. So let's say that you open a DAF and call it a Smith Family Environmental Fund, because Smith is your family name and you love supporting the environment. You set up a charitable life insurance policy, assign it to the Smith Family Environmental Fund, and it will be the Smith Family Environmental Fund that will generate a tax receipt for you. You see, this power, the timing, the complexity of getting all this paper, it all disappears. It's all in your hands. Say your accountant pressures you to donate a certain amount of money now because it's urgent and must be done before the fiscal year end. No problem. You donate it to the Smith Family Environmental Fund. And similarly, you designate your fund as a contingent beneficiary of your REIF or in your will. Every once in a while, you could adjust the list of charities to which the Smith Family Environmental Fund distributes the money. It's all, again, in your hands. But the Smith Family Environmental Fund itself doesn't go anywhere. And finally, it becomes a family adventure. You gather everybody, your spouse, your children, your grandchildren, and discuss with them, what charities will we support from this fund? In which amounts? At what time? Who will run this environmental fund when I'm no longer here? And those of us who have grown-up children who live somewhere in British Columbia or New York City or anywhere else on their own, they know that having a good reason for all of us to get together and do something meaningful is a blessing. And that's precisely what Candice and I call a complete philanthropic solution. You use all available legacy techniques. You put your DAF in the center of it. And from the DAF, from your donor advice fund, you distribute the money to the charities that matter to you. Financial providers such as Canada Gives, Mackenzie Investments, and different community foundations will happily open a DAF for you. The fee to open a DAF and maintaining it yearly is very reasonable, and it eliminates most problems that stand in the way of your philanthropic journey. Of course, this complete philanthropic solution is not a silver bullet, but I would say it is as close to it as it gets. All right, I think it was enough information for everybody today, if not too much. I will not provide any more. Let's move on to the next slide and summarize our presentation. First of all, switch to voluntary philanthropy. It simply makes sense. If you are obligated to pay a sizable amount of money in taxes, why not to direct it to the cause that you personally believe in, especially if CRA provides you with a wide range of instruments. Second, understand the challenges that you're going through. There are ways to overcome them, and I hope you have a better idea after this presentation. There is a wide range of technical instruments that you could use to enhance your donation and get additional tax benefit. You don't have to be an expert in all of them, but knowing the instruments and how to use them is a good practice. If you combine the available instruments with your own donor advised fund, you create a complete philanthropic solution. It's like having your charity, which is ready to help you and the causes that you care about most conveniently. And finally, you're not alone. All the technical information that you heard today might feel a bit overwhelming. We're here to help. Later in this presentation, you will see our contact information. If you're interested in plan giving strategies, give us a call or send us an email. We will happily answer your questions, and in many instances, we will be able to help you directly. Another professional team member supporting the Water Watchers is a Small Change Fund. Kim Bilous, the Small Change Fund representative, will talk right after me. You have a diverse and powerful team of professionals who can help you every step of the way. Over to you, Kim.
Thank you. That was a wonderful presentation and so informative. And that's wonderful that the folks who are on the screen today can also reach out to you. It was a lot of information, and even I've been working in this industry for years, and I was hearing new things even for me. So thank you for that, and thank you, Water Watchers, for inviting Small Change Fund. We are your proud partner in the success and the work that you do. And I don't want to add too much more information. This was such a chock full of so many good pieces of advice. But I will just stress that your charity that you're interested in is very much your partner as well. We are delighted to talk to you about your considerations, to look at your perspectives, to discuss with family as well, as Vlad was saying, and to ensure that your gift is used efficiently, exactly as you wish it to be used. When it comes time for language in your will, all of those things, direction of your gift, recognition, anonymity, please don't hesitate to contact me or Danny or any other of the charities that you might be interested in supporting. This has been a wonderful presentation, and I look forward to speaking with any and all of you about your interest in supporting Water Watchers and Small Change Fund. So thank you.
Thanks so much. Thanks so much, Kim. Yeah, we feel very lucky to have this beautiful partnership with Small Change Fund and to be able to grow our impact philanthropically. And now we get to move in to what is always my favorite part of these presentations. We actually get to talk about the content. That was so much information. I've seen this presentation before, and I learned something new every time I see it, I feel like, and it is just, it's fascinating to me. Sharon in the chat earlier said, I want to learn how best to use my financial resources to make the most impact on social justice and environmental issues. And I hope, Sharon, that the presentation that you just had really gave you lots of things to think about with that. And then just a quick reminder before we dive into the Q&A here that there will be a recording sent out for this presentation, so you can reference back to that information whenever you need. So I'm going to dive right into some questions. So Candice, I had one for you. You used a stat on how many people in Canada don't have a will. Could you say what that was again?
It was 5% of Canadians have a will, so 95 do not. And this is in
my mind.
Oh, sorry, my mistake. 5% leave a gift to charity in their will.
Mm-hmm.
So 50% of Canadians do not have a will, which is still too many. people.
Yeah, that's such a huge number. And then you said
Yeah.
95% of the folks that do have a will don't have any sort of planned giving included in it.
No, and that is when you don't do that, you end up paying estate taxes. So it's just a little bit more of a thought process. It's a very quick, well, maybe not quick, but you just want to make sure that you think about it a little bit more instead of just leaving it alone.
Mm. That's such a huge opportunity then to be able to if there's that many people out there that don't have that kind of planned giving in their will, that's such a huge opportunity area to make your legacy last in different ways, and so beautiful. All right, okay, so I'm gonna move on, get into some of the meatier questions. So we have a couple people on the webinar today who messaged me and said that they're single people, they have RRSPs, but they don't have anyone to leave money to. They have some investments. Again, there's no one to leave money to. How does this content relate to someone like that? They were just asking for a little bit of a clarity on approach for people who might be in that kind of a situation.
Well, this actually a pretty straightforward situation, not because it's not complex from personal standpoint when people think, what do I do with my money? How could it be impactful? But if we're talking about technicalities, how to direct money in their registered account to a charity, they simply assign charity as a beneficiary. That's that option number one that I keep showcasing anywhere I'm talking about this. It's very simple. It doesn't require any extra help, set up fees, anything. You just do that. If you want to enhance it a little bit more, then you combine it with charitable life insurance. It's also a possibility. As I said, there are new products that come to the market every once in a while, so situation is changing. So to summarize it, the first step would be talking to a financial advisor, like a sound financial person that you trust, whether it's your representative in the bank, whether it's someone among us here at presentation, someone who understands it and can direct you. But don't be afraid, it is not difficult.
That's awesome. Did Candice, you want to add anything?
Yeah, just need to be mindful of your different types of investments. So as Vlad mentioned, the RSPs, the RIFs, like those types are all the paperwork is done through the financial institution directly. But for non-registered, if you don't have a will, then that actually goes into a very big black hole at the end. So you want to make sure you do have a will to help the people who are handling your estate know where to allocate the money. And if you don't have a will even if you have the best charitable intentions, the charities are not going to get any support from you. So that is something that you want to make sure you set up, and you can direct, like as I mentioned in Willpower, if you have charity as one of your beneficiaries of your estate, then they will get it directly. But you can also set up the donor advised fund. Even when you pass as a single person, the donor advised fund administrator keeps administrating your donor advised fund because you've already allocated the charities that you want to be giving to within that structure as well. So naming of the charities is also very important. I know Wellington Water Watchers was a name for now your Water Watchers. So you want to make sure like that in itself could be the difference. If you put Wellington Water Watchers and the name changed one day, that means that the will actually doesn't recognize that charity. So you want to be extremely careful with that. And through like a small change fund, they would know exactly your intentions and where you want to be allocating your philanthropy. So Kim, maybe over to you.
Yes, you and Vlad covered this beautifully earlier about the communication. Very important to be communicating with your family, with your financial advisor, but the charity is also your partner in this, and you can choose what level of relationship or information that you receive from us. But the most important thing is the opportunity to work together to make sure, exactly as Candice says, that your wishes continue. And we would then know, for instance, maybe Water Watchers changes its name one more time to something else exciting. We would, because we know about your will, we would be able to contact you and say, this information just came through. We know you kindly left a gift in your will. You may want to change it so that it can be updated. So that communication is really, really important.
Sweet. Thanks so much for diving into the specifics on that. That's so wonderful. We had a question too about some of the words that were used in the presentation and what they refer to as far as like technicalities. So could you also clarify what registered versus non-registered means in this context? Candice, do you want to start that one?
Sure. Yeah, I'll start that. So registered just means TFSA, RSP, RIF, locked in RSP, anything that you had to open a separate account for that's considered a tax-free growing vehicle. It's called a registered account. And then non-registered is just your regular traditional cash account, so it's taxable. So some places call it a cash account, some places call it a taxable account. Non-registered account is also used. But just think of it as like that one is taxable upon, like if you sold some things to get some money out, it's taxable. Whereas the RSP, the registered accounts, if you're selling things within there, making different structural changes, you're not taxed on it until you have to take out money later on.
Sweet. Thank you so much. That's wonderful. All right. I have some questions about some of the things that I learned. I am absolutely fascinated by this concept of a donor advised fund, and especially because it seems like it's this pathway to be able to give with impact during your life, and also like create these beautiful opportunities for meaningful connection with the people around you to bring them into it. So you mentioned that you can start with as little as $10,000 as kind of like a starting point with a donor advised fund. I have technical questions about this. Is that like you have to start with cash for that, or can that come in like different kinds of donations to start?
Yeah, so you can fund a donor advised fund with cash, like you give cash to charity, but that would be the least efficient way in terms of taxes. But of course, 100% you can do that. That would be a great way to give it just a boost in the beginning. But the other ways that we mentioned of funding it through appreciated stock. So you don't want to sell the stock to pay taxes. You want to put the appreciated stock directly into your donor advised fund. That increases that amount. If you have a life insurance policy that you find that is not useful anymore, you can donate that into your own donor advised fund, and then the donor advised fund will get that benefit at the end. So things like that is you can use the different structures to fund the donor advised fund. Think of the donor advised fund as a charity, and it's your own family foundation charity. And then on the other side of it, you need to think of how to grant out money from that charity, the donor advised fund, in order to fulfill your overall philanthropic visions and missions and things like that.
I'd like to add to that technically you can start donor advised fund with $0. There are providers that allow you to assign life insurance policy to your donor advised fund, otherwise totally empty, and they will not charge you any fee until you pass away and money actually arrives into the fund.
That's amazing. And how does a donor advised fund grow over time?
It depends. Sorry, go ahead, Candice. Yeah.
So your donor advised fund is invested, right? And I noticed someone mentioned they support green investing. So you can invest your donor advised fund exactly how you would invest your, say, registered account. Think of it as a tax-free growing vehicle. So you're getting the benefits of that. You can allocate sort of socially responsible investments into it. But each of the donor advised fund administrators have probably a different way. So Mackenzie, I think, uses Mackenzie Investments, obviously, on the other end, the Mackenzie Donor Advised Fund structure. My firm, we use Canada Gives. And so Canada Gives is the donor advised fund administrator, but my firm, CCNL, on the other end of it, is the investment manager of it. And a lot of firms, they may have or may not have socially responsible mandates. They can, it can be very personalized like that. So it's technically your direction on how to invest it as well. You would talk to the administrator of it, but it's not your money anymore. So you have to think of it as like, yes, you have control of where the money can go, but it's not your money anymore, even though it's sort of within your, say, family name, family foundation.
That's a really important distinction. I appreciate that, Candice.
Sorry, I
Please
just
take it.
got a question in there too. You can use mutual funds to fund a DAF. So thank you for the question there. You can use, mutual funds, ETFs, really any investment, like simple traditional investments, you can use that to fund it, but make sure you do it through a appreciated security way and not just selling it and then putting the money in, because you then don't get the benefit of not needing to pay tax.
Yeah, I think that that's the one that we've been hearing on repeat, right? Is like, make
Yeah.
sure that you're doing it in the way that gets you the tax benefit as well. So that's great. We have a couple specific questions extra. Jane asked about what about TFSAs? Is that kind of the information that we heard about RSPs and RIFs? Is it similar, or is there a little bit of a different approach with that?
Well, for TFSA, you do not get, I would say, additional tax break, because TFSA on its own is the best tax break that we could get in Canada. So money there, if properly invested, it grows and it will never be taxable. Of course, you can use this money to make a donation to donor advised fund, to charity directly, but there is no additional tax leverage. Like there's no that wow factor that I personally usually look for when finding those techniques.
Sweet. Thanks so much, Vlad. Okay, this is an interesting one, and it is about leaving money to a charity in your will. Sharon said that she was warned once about leaving money to charities in wills, and that a charity can hold up on the execution of a whole will. I wonder, like, if you have thoughts about that, if you have experiences with that, because obviously that you want to make sure that things can move along for your loved ones.
Maybe Kim, since you've worked in
Sure,
charity space?
I'm happy to take. Sure, I'm happy to take that. Again, goes back to, it's, I feel like a broken record. It goes back to the communication, financial advisor, individual, family. What happens is there is miscommunication or misunderstanding about the intention or the direction of the gift in the will. And that's a really important thing to be able to make sure doesn't happen. And that continued relationship, many charities have legacy giver programs that keeps a consistent communication, which you can then share with your family members, and you can share any changes again with the charity. And that will help enormously in making sure that things run smoothly when you really need them to run smoothly the most. Sometimes, however, things intervene, family politics, etc., that can't really be anticipated. So I'm not sure we can smooth out every bump with good communication, but it's certainly a good place to start. Candice, you may have other more technical thoughts on that.
Yeah, so I mean, I have heard a lot of horror stories, so it's not all a myth, but you just have to be very careful. And it comes down to proper naming, proper, there's also a stat where there's plenty of charities that unfortunately don't make it. And so if you forget about them and they're in your will, then, it does become that extra step. So you do want to be on top of it if you're doing it, but it is a wonderful way of actually getting it done efficiently that way. Even big charities, for example, I'm on the board of UHN Foundation, and they used to be called something else, and they're a big charity and they changed their name. But there's going to be a time period where if they were left with their old name, they would still be able to receive the gift. So there are different ways around that, but you do want to be careful. You want to make sure you don't want to just leave it for 15 years and forget about it.
Yeah, that seems very, very important. And that's, I think, too, where your relationship with your financial advisors and your lawyer come in as well, right? That as you're moving through the execution of these things, having that ongoing relationship with the charity, with the people who are helping you do this planning is key. All right, we have another question here from Maggie. Maggie asks, if a real estate investment can be included into a family trust, or if you have to do capital gains on that kind of thing. They also asked specifically about if they say, can this kind of investment be incorporated into a family trust, which would be necessary because of a plan for a disabled person, for the full context there. So Candice, did you want to start?
Sure. So I have plenty of clients who have family trusts, they have holding companies, they have registered accounts, they have non-registered accounts. So they have everything. And usually I work with their accountant on structuring it properly to put into a family foundation, a DAF. And so where we normally see it is like, where's the best taxable situation for that family? So you do need to talk to your accountant. And then the accountant would say, well, take it from the corporation. That's going to be the most tax efficient way. You can donate from a family trust, is 100% is possible. But unfortunately for real estate, if it's like, so there's a few things here. So for real estate, I've had farm families where they were sold pieces of land, and let's pretend that's, considered in the sort of the same way. They wanted to donate the land into a family foundation, so they get a tax benefit. And then that DAF, the DAF administrator, not all of them can do this, but some of them can, they will facilitate the sale of the land to the developer, for example, because ultimately what that family wanted to do was sell some of the farmland to a developer to build houses, but they would have to, it wouldn't be as tax efficient that way. So what they did was actually used it through the DAF. So they sold their farmland into the DAF, they donated to the DAF then sold it to the developer, and the family got the benefit of having money within the DAF to use for philanthropy. So there are ways around it, and these are quite hard questions because they're very personal, and I think we just need to talk to people one-on-one sometimes for their situations. But is back to working with your trusted advisors. It is a combination of working with your charity professionals, your financial side, the accountants, the lawyers, and also the DAF provider. If it becomes complex like this, they are great resources as well.
I just like to really outline here that whenever we're getting extra entities such as trust or even a corporation, it is never an over-the-counter medicine. It's always a highly prescription drug, if I may say that. So we're happy to answer these questions, but I would encourage you not to rely on them. In order for any of us answer this question properly, we have to see trust deeds and all kinds of other documents. It's very, very specific and situation tailored.
And that's why you're here, so that we can have folks to lean on, right? In this process, we don't have to be the experts. There are experts that we can lean on and get the advice from, and hopefully let that guide our impact most successfully. All right, we have one more question from the chat here from Remy. They ask, do you have any recommendations for tax efficient strategies that charities can use when receiving gifts of securities? Are there more efficient approaches than simply selling the securities?
I can give it a start. Maybe Kim, you can add on. So in my practice, I also manage money for foundations. And so we do have accounts that receive gifts of securities for the charity, to the foundation. And it really depends on the charity's policy at that point. They'll have a gift receiving policy, and some of them say sell it right away, and some of them may say hold on to it. It really depends again. There's no tax efficient strategy beyond that because it's already within a charitable structure. And so at that point, it just becomes how does the charity want to use the funds? And once it's in their hands, it's leaning back onto the charity's visions and mission and what they want to do with it.
Kim, did you want to add anything?
I would have said exactly the same thing. The charities have policies set by their boards. Most of the ones that I know require an immediate sale because of the risk of losing some component of that donor's generous gift in waiting on the sale. One of the other thing is that to make sure that there is an understanding whether this gift goes into an endowment and therefore have the best investment strategies as well. That's an excellent way to make sure if it's a large gift and you and the donor have decided that it goes into a longer term investment, or whether it's expended immediately for an urgent project, which also has its own very, very efficient, I won't say tax efficient, but there's a huge efficiency to that. We are in a situation where environmental giving particularly is quite low in Canada by percentage, and these significant gifts, as gifts of securities often are so important to get some urgent work done right now. So you have to think about efficiency in a couple of ways. That's what I would suggest.
Sweet. Thank you so much. Thank you so much for that, Candice and Kim. That was great. All right, I have one last question for you all, and it's just there was a lot of information today. If you had to give kind of one take-home message for people to walk away with from the presentation today, what would you hope that people really held on to from this concept of planned giving? Vlad, do you want to start?
I would start gladly. I think that the main takeaway would be just looking back at your own financial situation and your charitable giving strategy. Just look back and rethink. If you already have a budget and this budget includes that much money for a charity, it doesn't mean that your charity has to receive that much money. They can receive much more because Revenue Canada is standing on your side. They enhance your donation with the tax dollars in all kinds of ways that we discussed today, and we actually didn't even have time to discuss all of them. So just rethink, give it a second thought. You can achieve more than you thought before, I guarantee it.
See, thanks, Vlad. Candice, you want to go next?
Sure. I would say before you make your next donation, really think about how you can do it differently. So as Vlad, it's a little bit of the same as Vlad, but I would say start today. Don't wait till next year. It's funny because my mom's in her 80s and she somehow cannot stop the monthly giving that she gets mail and she just needs to give that way. But then she does the different strategies on top of that, but she can't seem to stop doing the monthly giving. So that's okay too. If that's like a routine and something you're comfortable with, continue the small donations that way, but there are different ways to make bigger impact gifts. So just before you make the next donation, think about it and see how you can do things a little bit differently.
Sweet. Thank you so much, Candice. Last but not least, Kim.
I completely agree with what Candice and Vlad said. I would call it sort of stay tuned because there's always something to learn and fascinating ways that you can make your dollars go farther for the charity. But I think in addition to being in solidarity, I would want to ask that we really look at what we want to accomplish with these gifts and with our legacy, and what is going to make you smile and what is going to make your descendants smile, because they feel like this speaks to our family, this speaks to my friendship. And to be able to feel like you are accomplishing something with a real partner in the charity that you're working with, you can do that and it'll make you feel like $1 million.
Thank you so much to all three of you. This has been such a fascinating time together, and I'm just grateful to get to hold this learning space and to know that this is a continuing learning journey and one that we can be in with each other along the way, and also making impact while we do it. It doesn't have to wait until a certain time. Like it can start now and the learning can grow. So that's beautiful. Thank you again, everyone, for attending as well. It has just been, I love getting to talk about this stuff. I do a lot of our fundraising at Water Watchers, and I love getting to hear these stories of how you can really make sure that things are working better for the charity and for you and your family as well. I just have one last slide. We've heard a lot today about this area of planned giving and modern philanthropic giving. And I just have a couple final thoughts on some other ways that you can also make your dollars work for the environmental movement. So someone earlier in the chat mentioned that they had divested their finances, which is an amazing thing. Most of the big banks invest in fossil fuels, so they're funding things like pipelines that are destroying the lands and waters that we are striving to protect, and moving your dollars away from those investments is really a beautiful way to vote with your dollars for the future that you want. And you can even do something as simple as talking with your branch manager if you're not ready to make that commitment from moving away from TD or wherever it is that you bank right now, that you can talk with your local branch manager and say, divestment is really important to me. Those conversations go a long way. And then just to speak to your purchasing power also, as you vote with your dollars, as you buy, buying local and buying less always goes a long way. The less resources that we use, the less distance things have to travel, the more dollars that stay in our local economy with small businesses, the more impact that we're going to make for the future that we want. All right, I'll just have you flip over to the next slide. And just a reminder to stay in touch. I put my email in the chat as well. It's Dani, D-A-N-I, at waterwatchers.ca. But please feel free to reach out to Candice and Kim and Vlad if you have any questions. If you want to talk about your specific scenario, they're here to help you, and will give you some of the guidance you need and let you know what is next on the list of to-dos for getting your dollars working harder and better and stronger and more tax efficiently for the environmental movement. So one final thank you, and I hope that you all have a beautiful day.